Hello guys, welcome back to Residencia. Here in Residencia we help people to be bulletproofed against tax audit, or well, international tax audit, when you have a business abroad and you as individual you are living in a different jurisdiction and you own this business in another jurisdiction. So you have an international situation, international business structure, and you need to be bulletproofed against multiple tax authorities that might want to trigger some audit, some tax controls, and we help you to provide and prepare in advance all the bulletproof defense file that you can hand over straight to the tax authority without any issues. In this specific video, I just want to talk about the jurisdiction of Cyprus. Cyprus is quite well known among European Union countries because it has a very nice tax regime especially for new resident, which can be applied for the Non-Dom regime. It's a very specific and particular Non-Dom regime. It doesn't really work like the rest of the Non-Doms regimes in UK, it used to be in UK, then Ireland, Malta and other Commonwealth countries, but it has its own structure, its own tax benefit that works in this way. It's not like working the way that if you make money abroad and if you remitted in the island you pay taxes. It's not really like this. It's a different way of having a Non-Dom status. And if you want to know more, because in this video I'm just going to give you the most essential point, but if you want to understand exactly how it works, if it is applicable for your specific situation, let us know, because in the description below the video you will find a calendar link in which you can book a consultation with us. Now, I want to explain exactly how it works, generally speaking, and what is the hidden trap behind a lot of people are not aware of. Okay, everybody around YouTube advertise this beautiful tax regime, but there are some traps, some hidden, details, and we say that devil is in the details. So we are going to discover these details. Now, first of all, I just want to remind you that the tax regime, how it works, very easy, very quickly. It's a 17 years tax breaks, okay, under the form of Non-Dom. It's called Non-Dom, not domiciled, and not domiciled means that basically you're not Cyprus citizen, neither you lived in Cyprus in the last 20 years. And basically, if you're a new resident with different citizenship, you can apply for this regime. But in order to apply for this regime, you have actually two options, because you can get the Cyprus tax residency in two ways. The first one, I pass 183 days in the island, okay? The other possibility is 60 days plus having working contract or administrator of a company plus disposition of a home disposal. And home disposal means either I'm under rent or I'm purchasing the property, okay? And if you fulfill those requirements, you will be entitled to receive the tax certificate from the Cyprus tax authorities, through which you can be bulletproofed, because the tax certificate is the first document that you have to provide in case of checks, audits, or in case you have an issue of double taxation residency, a double tax request from two jurisdictions, one from Cyprus and one from the jurisdiction probably you're coming from. And the tax certificate is the first document that you have to show up, along with the rest of the documents to prove the rest of the elements written and described in the International Taxation Treaty between Cyprus and the country involved. But the tax certificate is the first trigger point to invoke the International Taxation Treaties. Without it, you cannot do anything, okay? Now, you have the situation here, and you have this tax benefit, which is the tax benefit? The tax benefit is the following. You pay 0 tax on capital gains, 0 tax on interest from abroad, also local, 0 tax on dividends, okay? But this is another trick that maybe you're not aware of. There is a small tax to pay on these two here, not on capital gains, but on these two, which is 2.65%, which is the health insurance or public health tax to make the public health run. Okay, so you pay some contribution, which is 2.5% on this type of income, of this type of stream of incomes, capped at 180k. Okay, so above which you don't pay anymore this 2.65%. So if you're making million, only the first 180k will be subject to this 2.65%. So it's not true that you paid zero tax in Cyprus. It's the real tax pressure is 2.65%. So it's the first misconception. Then another misconception, maybe you're not aware of, is that therefore the rest of the foreign incomes, which are not subject to withholding taxes because capital gains, interest and dividends are normally subject to capital gains withholding taxes. The rest of the foreign income that flows in the ordinary taxation brackets, progressive taxation brackets, because also Cyprus has the taxation progressive brackets. So the foreign income, for example, you have rental income from abroad. It flows, even if you are not DOM, it flows to the tax bracket system in Cyprus. And of course, Cyprus has a very nice, big 0% bracket, the first 22,000 euro. And then if it goes up to 35, I'm not wrong. So they have the tax bracket, they are not so high, and they start with a big 22% exemption. But if you have multiple rental incomes from abroad, the rental income is just an example. So if you have type of income that flows in the taxation bracket system, you will be subject to this plus the brackets that you reach. If you stay under 22,000, you pay zero. But if you have your administrator salary or an employee in Cyprus, and this flows everything here, plus rental income from abroad or other type of income from abroad, you will pay 2.65% on this income, and only the first 22,000 is tax-free. Even if you're not DOM, if your total stream of income that flows in the progression taxation rates, if it passes 22,000, you start paying taxes. It's not zero, okay? Plus 2.65% always. The 2.65% is just exempt from capital gains. So if you're running or if you're living out of your capital gains in Cyprus, there is completely tax-free under not DOM. Of course, if you're not DOM, you have other rates, and we are going to discuss in a different video, because now the purpose of this video, that I just give you this introduction of how nice is Cyprus, I'm going to tell you now what's the hidden trap behind it. Okay, so this is at the personal level. At the corporate level, Cyprus has 15% flat. So whatever type of business you run through a Cyprus company, you have 15% flat, okay? This is what you pay. And zero tax if you have a holding company holding other operative companies in Cyprus and the rest of the European Union, or depends on the country through which Cyprus has a similar agreement that exempt you the dividend into the holding company to be zero. Okay. Now the problem of Cyprus is the following: if you're moving there, you're an administrator of the company, you open the company in Cyprus, you bring your family, and everything is fine, but you don't stay more than 60 days. You know what happened? That the Cyprus Tax Authority don't give you the tax certificate. Haha. You see? Even if you have a working contract, administrator of the company, the family in Cyprus, plus the home disposal, right? Because either you could purchase it or not, but if you don't stay physically counting day by day, 60 days, and the day of departure are excluded from the calculation, you'll not get the tax certificate. What does it mean? It means that by mistake you're traveling around the world and you think, okay, I'm fine because my tax residency is in Cyprus, but I spend the entire year abroad. I don't have that specific tax year that I left Cyprus for 200 days, 250 days, almost the entire year. I'm not tax resident in Cyprus. And this is quite an issue and a quite dangerous position. Why? Because let's imagine in 2027 this will happen to you. 2027 you risk to be non-resident anywhere. Non-resident. Okay? Because Cyprus doesn't give you the certificate. Because Cyprus wants that every points are at the same time, they are cumulative, are not alternatives. If you're going to another European countries at high taxation level countries such as Belgium, Italy, Germany, France, they ask you just an alternative point to attract you as a tax resident. just passing 183 days, or simply build a tie, or simply have a home at disposal. If one of these elements are verified on their local national law, you are tax resident there. But Cyprus is the other way around. This island that attracts individual very low taxation, they demand you to have all the elements together at the same time verified. So if the days is the most dangerous one, because you might want to be free to go wherever, is not verified, it's a big issue because you're not tax resident that specific year in Cyprus, which risks you to get taxed that specific year to your former country of residence. Risk that. And how do you risk that? How is possible? Because the former country resident, that you cut all the ties, it doesn't have anything. The problem relies on banks. Your banks, whatever they are under the Common Reporting Standard System. Common Reporting Standard System. If one of those banks requires you to update their KYC on that specific year, and they ask you the tax certificate of Cyprus, and you don't provide them the tax certificate of Cyprus because you were not tax resident because you missed the days, those banks, they might, not all of them, but this is a very, very high probability risk, they send information about your bank account and values to your former country of residence, or the country of citizenship, or where you were born. You have this risk, and if this information goes back to the country of origin, the country of origin might trigger tax residence to you. They might ask you to pay taxes, and you cannot oppose anything. You cannot oppose your contradiction, because you cannot defend yourself because Cyprus doesn't give you the tax certificate. So you're not tax resident there, and they basically have the rights. They might have the rights to tax you on this income exchange from the bank because of the Common Reporting Standard thing. Okay, so it doesn't really mean that this happens for sure, but there is a very high risk that your banks under CRS could send this information back to your countries of origin. This is just a hint of what could happen. Then in the consultancy below the video, we can discuss exactly how everything works in details. But because of this, you might risk to send financial information to the former country of residence, which and then at the same time you miss the tax residency for that specific tax year, you don't have any document to be bulletproofed against these tax authorities. Okay? I hope I was clear in this video, and I hope I clarified this hidden dangerous element of being Cyprus tax resident. See you in the next content. Bye.